So yeah, thank you very much for joining the first community call for liquid staking. What I'm going to do is just for kind of 10 or 15 minutes, I'll just give you an introduction to some of the background of the project and how we've got this far. While we're doing that, I'll introduce the Chorus team and give everyone a chance to briefly introduce themselves and their projects. Yeah, once we kind of give a bit of background, Brian is going to give a little session just about an introduction to liquid staking. So we'll go into some of the things we've been looking at, some of the ideas we have, and then so I guess we'll do that for kind of about 20 minutes, half an hour, and then out of that, then we want to have an open discussion and get the community discussion going. So we want to leave as much time as possible for everybody to kind of give their contributions. And then I think as we wrap up, what we want to do is kind of start to think about what the agenda is for the next few sessions. We're going to do this every 2 weeks for the next 4 months. So we want to start getting a view of what we'll cover on the next call in 2 weeks, and then on the calls after that. So as we wrap up today, we'll try and make sure we start to piece together the agenda for the future call. Yeah, so let me just give a bit of background of Chorus and how we got here. I guess as many of you know, Chorus have been running validators on many crypto networks. We were heavily involved in Cosmos Game of Stakes and run validators on some of the Cosmos zones. And lately we've been working with networks like Solana and Near and various different, actually a lot of people that are on the call or at least in the Telegram group. And during our investigations around our strategy and trying to figure about the future of staking and what's going to happen, I guess this idea kept coming up of, what happens if we make staking liquid, if there's some kind of derivative of a stake that then could feed into other DeFi products, what would that look like? What's the implications of it? I guess we started to hear a lot of people talking about it early last year. And that led up to us in June, July, we were at the Cosmos Hackathon in Berlin. And we worked on a project with Sika called delegation vouchers, which was, a proof of concept around what liquid staking might look like. So we built out a first version of that. And, we got a lot of, interest from the community, and we said, okay, well, let's follow up and see what we can do here. Later this summer, then we went to Korea, another Cosmos Hackathon. And this time around, the winners were Everett, who also built a variation on staking derivatives with a model called B Atoms. And also while we were in Korea, we brainstormed with Bee Harvest, and we had some ideas around, other models that might work. And we started to realize actually this could be a big space. So around that time, we pitched to the Interchain Foundation to get grant funding to explore the space. Now that's taken a little while to get approved, but in December we've got the funding for that. So we've been working closely with the ICF, the Interchain Foundation, to get that approved, and now we have that funding, and they're the ones that are funding this community effort. So very, thank you to them for helping us out there. And I think when we sat down with the Interchain Foundation, we said, look, we don't want this to just be about delegation vouchers or one particular model of staking, like liquid staking. We realized that there was so much going on that we wanted this to be a holistic view of everything that's going on in the space. So the scope we agreed with the Interchain Foundation includes things like, delegation vouchers, the Everett model that we mentioned already, some of the Bee Harvest ideas, but also things like potentially slashing insurance using prediction markets. We're starting to see things like TBTC and REN, projects where you could potentially have a decentralized network that controls assets and therefore acts as a decentralized custodian of assets, and therefore opens up potential for doing clever stuff with staking. We also started to see Binance, Poloniex, Kraken, various exchanges starting to offer staking offerings. So the custodians are also getting into the space. And then we also started to see more recently things like DAO designs. So we saw Staker DAO, Stake Capital, Stake DAO. We saw Cryptium looking, what they call programmable staking. And then I guess in the last few weeks, we've seen Staffy Protocol, who just received funding from the Web3 Foundation for a liquid staking model that they've designed. So we've been exploring that. So there's so much stuff going on. We just felt that, look, we need to get everybody involved and get everybody discussing this. So that's kind of a background on the projects that are there. So what do we actually want to explore, right? So again, the scope we've agreed with the Interchain Foundation is to cover a kind of 360 view, right? It's not just about, how do we build DeFi products with liquid staking? It's the implications of liquid staking, particularly on network security. What does it mean, when stakes are liquid? Is it going to impact security? Is there centralization risks? What happens with governance? So, if governance is tied to your assets being staked, then, who has governance rights when the assets are liquid? Will it create like competition or distort kind of how the whole crypto space works? I guess the one thing that comes up quite regularly is this idea of like, will we cause a financial crisis, like a crash in the crypto space? Because, is this a bit like mortgage-backed securities? Is this 2008? So the risks and benefits of financialization is something that we want to get into. And then I think there's the whole thing of like, how does this all work in a cross-chain context? So if people are moving assets between chains and you have bridges and peg zones, if the networks that are talking to each other have these liquid staking models, then how do we reason about security? How do we reason about interoperability in this world? So as you can see, there's a lot to cover, which is why we want to do these calls so regularly every 2 weeks, because we do want to make sure we can go deep in as many different areas as possible. And we do want to make sure that everybody gets to participate. So we will be inviting all the projects that are working in this space, to tell us what they're working on, how it works, and discuss that. So plenty to cover. Just before I go into intros, I guess most of you will see we have a GitHub repo up there. It's the Chorus One repo / liquid staking. So have a look there. There's a brief on the project. I guess you're all in the Telegram group, but we'll share links again just in case. Also on the GitHub, there's a reading list that we're trying to keep up to date of all the projects, all the ideas, all the technical proposals, everything we can find that's relevant. We're trying to capture there. So fire in pull requests or give me suggestions of things that you need to add there. But we want to make that the kind of the reading list that everybody should be reading if they're going to be involved in these discussions. So before I go into intros, is there any questions so far?
No, it's pretty clear.
Okay, cool. So yeah, let's start. We'll just quickly, we'll run through the Chorus team. Unfortunately, Maher is ill today. He wasn't able to join us. So just quickly, I'll start with myself, Brian, and Felix, and then I'll go through the list in the chat. So yeah, just from my background, I'm going to be acting as the project coordinator for this. I've been working in tech startups for 25 years. Got into crypto 2015. For Chorus One, I look after business development strategy, but we're working across a lot of different areas, do a lot of work with research, work closely with Felix on some of the content production as well. Brian, do you want to jump in?
Yeah, absolutely. So thanks much for the intro, Brandon. And I'm super excited to working with you all on this. So I've been working in the blockchain space for I guess around 7 years now. Some of you may be familiar with Epicenter, the podcast I started, and Sunny is a co-host as well on the call here. And I was also part of the Cosmos team. So I joined the Cosmos at the start of 2017. I was the first non-developer and COO there, and worked also quite a bit on some of the economics of Cosmos. I'm going to speak a whole lot, but yeah, and then in the end of basically around 2 years ago, I started Course One together with Meher, and we've been working on like lots of different things around proof of stake. And I'm going to speak much more just in a little bit about sort of some of the background behind this project and our interest in it. So I'll leave it at that. And yeah, super excited to work with you all.
Okay. Yeah. Hi, I'm Felix. I'm research analyst at Chorus One. I've been thinking about staking a lot, writing the Stake Economy newsletter too. And yeah, looking forward to working on this. I will be basically leading the actual writing of the research report. So feel free if you have like material, and at some point we will also probably share the first drafts and things like that. So that will become more clear over the course of this working group.
Okay, great. Yeah, so everyone on the call, if you could just we'll go through the list in order there. If you can just say what your name is, what organization you represent. And I think the main thing we want to know is what do you want to get out of participating? What's your goal for being involved? So Gavin, let's start with you.
Hi there. Yeah, Gavin Birch from Figment Networks. I'm here just to learn. I think this is a really important endeavor. So I'm excited to learn more about it.
Okay, great. Sonny?
Hey guys, my name's Sunny. I work on the Tendermint team as well as on Sika. I've been thinking about staking derivatives for a long time. I worked with the Chorus team on the original delegation vouchers stuff, and then I expanded on that work on the fungible delegation shares spec design that I did, which makes it okay. And so, yeah, my goal is kind of to hopefully convince everyone that the fungible delegation shares is the right way to implement this, and that we need to do delegations like derivatives in protocol. But yeah, so looking forward to discussing.
Great. Thanks, Sonny. Nicola?
Yes, hello everybody. I'm Nicola. I'm with Levis Cup. It's a crypto fund out of Hong Kong. I'm dialing from Hong Kong at the moment. In my previous life, I used to trade derivatives, and when staking came along, I saw like a new asset class pretty much that could have different use cases, and I linked it with the derivatives that I used to trade before. So I'm very interested for that. I wrote something about it last year, and as soon as I started basically thinking about it, I realized that there were so many components of it, like security, governance, and things like that. So I've been looking at the space since that. I'm here obviously to learn, to contribute in any possible way, and we invest in teams in their earliest days. So thinking about how to build the network and building the staking mechanism for them, it's very important. It's an added value that we want to contribute. So I'm here to learn and then pass it along to teams. Thank you for the opportunity, obviously.
Great. Thanks, Nicola. Chris?
Hey guys, Chris Hauser from Polymath here. Been in blockchain for 6+ years now. And with Polymath, what we're doing is building a blockchain specific to securities. And we're making a proof of stake chain, hopefully coming out later this year. I'm just fascinated by staking and everything it has to offer. Really looking just to learn more about what we can implement on our chain to best serve the community and make it robust and reliable for everyone that's going to use it in the future. I'll add that Adam from our team's here as well. He's a developer, I am not. So maybe he can go next and just speak more to that.
Sure.
Yep. So hey, so this is Adam from Polymath as well, as Chris just mentioned. So I mean, really, I'm here to learn. I think as Chris said, we're building a network which uses proof of stake. So we're sort of very interested in trying to understand like what the impact of liquid staking or staking derivatives and so on might have on our kind of assumptions around security. What impact we might see as a result of these types of products around competition between different protocols and that type of thing. As people move between, maybe it makes it easier to move between different protocols and so on from a staking perspective. So really just kind of here to learn, try to understand a little bit more about the impact of these derivatives on kind of consensus protocols that rely in one way or another on proof of stake.
Okay, great. Thanks, Chris and Adam. Hyung?
Hi, I'm Hyung from B-Harvest. We are one of the validators on Cosmos. And we are also researching on this liquidating delegations. So we approach it different ways, but one of the plan we have right now is to use group key, which is under implementation by region network team. And we will use this feature to build delegation DEX, which is a OTC decentralized marketplace to trade the delegation object itself. So I think it will be a good bridge solution before complete liquidation of staking. And I also want to discuss more about the entire picture of the DeFi ecosystem around the Cosmos, because if everyone builds different blockchain, then it will separate all the securities. So shared securities or co-working or collaboration will be an important factor for our ecosystem.
Great. Thanks very much. And thanks for joining. I know it's very late there. I guess the same for Michael and for Ryan. So thanks. I really appreciate you joining so late. We'll try and make it at a better time for you guys next time. So Michael, do you want to go next?
Hey everyone, this is Michael from Stick With Us. We have actually been doing a bit of research into staking derivatives back since September 2019. So we believe is one way to really improve decentralization, and I think very few people are realizing that staking derivatives is going to disrupt existing DeFi applications from bottom up. We think that stake assets will become usable for other yield enhancing applications. So interested to learn more and see how we can contribute. We think this is an industry that cannot be controlled by one player. It has to be a collaborative effort amongst everyone, every stakeholder, liquidity providers, exchanges, validators. So happy to learn more. Yeah.
Okay, great. Thanks, Michael. Ashish?
Hi. So hi, I'm Ashish. I'm working with Matic Network. So mostly I work on proof of stake mechanism. So like since I started working on pause mechanism, I saw that there is too much of illiquid assets in which are logged, and whenever someone is taking like unstaking, then there is too much of capital logged for a certain period. So that's why we introduced the NFT mechanism, so that you can just transfer your validator stake to some other validator who is ready to validate. And also when I saw the staking voucher mechanism by Chorus One and Zika, it got me interested, and I also started working on it. And like in last few months, I've also discussed with Felix like few of problems which I was facing. So yeah, I'm here to learn and share stuff basically.
Okay, great. Thanks, Ashish. Arjun?
Hey guys, my name is Arjun. I work at Paradigm. We're an investment firm in the Bay Area. We are excited about Cosmos, and one of the things that we've been looking at is ways to get liquidity on staking positions. So we explored this with a few folks building OTC derivatives. And so I think a lot of the work that's being done here and in building kind of on-chain crypto native derivatives are, going to inform those efforts. So really excited to, hear more in the discussion.
Okay, great. Thanks, Arjun. Eddie?
Hi guys, this is Eddie Barcelos. I'm in Los Angeles. I run a private fund out of the Netherlands called Mipera BV. We have a few software as a service companies on our portfolio. A few of them are staking operations. That's the part that I'm interested in the most. I want to learn about this project more. I've been in crypto since 2013. I'm really interested in seeing incentives to combat centralization, especially by exchanges, and also to incentivize deconcentration so that we have a more evenly distributed voting power.
Okay, great. Thanks, Eddie. Adam? Oh, sorry, Adam, we covered you. Sorry. Deepanshu?
Yeah, hi guys, I'm Deepanshu. And we work on implementation for enterprise focused applications.
I think we can't hear you well. Maybe you're a bit far away from the microphone.
Oh, okay. Can you hear me now?
A bit better.
Oh, okay. I'm sorry. Yeah. Hi guys. I'm Deepanshu for Persistence. And we work on enterprise-focused blockchain application. We've built one a high-seas commodity trade platform called Complex, and we'd love to explore synergies. That's what we are interested in.
Okay,
thanks.
great. Thanks, Deepanshu. And Andy from Interchain Foundation, who are funding this. Andy?
Hi guys, yes, I'm Andy Nogueira. I'm from Interchain Foundation. I'm in Toronto, Canada. I work as a grant manager, product manager with Interchain, mostly helping, for those who know, like Ariane and Ethan Buckman. And I work with Brian Brendan on this grant, so define the scope and some the objectives that we wanted, as Brendan just said. And my goal here is just to sit and listen to the community. We're happy that we could get this funded, and Chorus is leading this with the community. And so I'll try to participate as much as I can on these weekly calls.
Great. Thanks, Andy. Francesco?
Hi, everyone. My name is Francesco. I run a crypto fund based out of London. And we've done quite a lot of research internally about staking derivatives. So I'm looking forward to contribute to the conversation.
Great. Thanks, Francesco. Ryan?
Hi, my name is Ryan. I'm from Everett Protocol. There's also Dogemas as well. We're one of the implementations of staking derivatives. We're currently focusing mostly on Cosmos. So one of the implementation methods we use is called like interchain accounts. I'll go in a bit more deeper later. And yeah, from this chat, I would like to gain more insights from various people, maybe a bit more opinions on like the market size as well. And yeah, that's it.
Okay, great. And Dogemas, you want to speak here?
Sure. Yeah. So I'm a part-time contributor to Everett Protocol, and yeah, I'm just really looking forward to seeing and comparing objectively the different staking derivative models, and just trying to discuss into making a very usable blockchain without compromising its security.
Okay, excellent. Thanks, guys. Marwan?
Hi, guys. I'm Marwan from Unsplash. Basically, we started looking into staking derivatives back in March, April, May. I was trying to see what could be done in this space in 2018, and I had some discussions with Gauthier from the Tendermint team, discovered what Chorus One was doing, started working on something similar to what Ryan and Everett Protocol did later. And basically, we figured out that that this subject is pretty complex. So we moved to the slashing insurance part, and we started exploring different risks that are related to staking derivatives and DeFi. And we are currently building an insurance protocol.
Okay, that's great. Thanks, Mohan. Okay, thanks everybody. I'm going to hand it over to Brian now. So Brian's just going to give you a little bit of context on where we're coming from with this project.
Brendan,
Yeah.
hi, could I just jump in, Brian? Christian from Staker
totally.
DAO. I just jumped into the call a little bit early. So like I said, Christian from Staker DAO. I spent the last couple of years in traditional finance, but I'm a bit more new to the crypto space over the last 6 months or a year or so. I think our goal here at Staker DAO is kind of just to learn best implementation details and any risks associated with these derivatives. And I'll keep that at a minimum. Thank you.
Thank you.
I wanted to jump in and quickly introduce myself as well. Joined a little bit late as well.
Sure.
Yeah, go ahead. Yeah.
Yeah.
Please.
So my name is Tushar, along with Deepanshu. We're both working on Persistence, which is the enterprise hub of Cosmos. And like Deepanshu said, we're trying to bring high value transactions through different enterprise focused applications. So we've been working on our own version of a delegation voucher with some of the old Cosmos community members. So we'll be coming out with this paper in the near future. What we believe is the future of, and this is a way for us to bootstrap our network as well. Some of you may have seen that the persistence validators, we still yet to rename our moniker, but the persistence validator went up recently. What we intend to do is what we call an initial delegation offering, where in order to bootstrap persistence outside of traditional sources of capital, what we're going to do is run our own validator and request for delegations to the validator that we will be running. We'll be implementing a 100% commission rate. And in return for putting 100% commission rate, we're going to be compensating the delegators with the persistence token. We believe that this is a truly this is the only possible way of bootstrapping a network with absolute no risk of loss of principal to the investors or the delegators in this case, unless obviously we ourselves get slashed for double signing or other kind of malicious activity. The only loss is to potential investors or delegators is in the form of opportunity cost of the block rewards or the transaction fees that they're giving up. So we believe that this is, we've had the kind of ICO wave and the IEO wave over the last 2-3 years. We believe that costs, especially in the Cosmos ecosystem, this will be truly kind of a revolutionary way of bootstrapping networks. It will lead to much better distribution.
Yeah, no, thanks very much. I think that's very helpful, but let's try to keep the interest really.
Sure.
Anyone else want to?
Hello, Julien.
Hey guys.
Oh yeah, Julien, go. Yeah, please go ahead.
Okay, cool. Yeah, sorry for being late. I just landed. So yeah, I'm Julian Boutoulou from Stake Capital. We've been building Stake DAO over the past year, and so basically the idea is to tokenize the what we've been running at Stake Capital, different networks, and we've been working on liquid pools, staking derivatives, and also creating the SCT token. That's it.
Thanks,
Well, thank you.
Liam, you wanted to say hello there, did you?
Yes, I'm sorry to be late. So a brief introduction of myself. I've been working on Staffy protocol since the early in 2019. We used to be a staking as a service provider, and for liquid is a big problem between mainnet security and token liquidity. And that was the aim to stop, and that's it.
Hey, I'll jump in and intro as well. I'm Leopold Joy from Stake Capital.
And as Julian said, we're working on Stake DAO and some liquid tokens inside of the Stake DAO. So just eager to collaborate with everyone here.
Okay. Thanks, Leopold.
I might be the last one. So I'm joining in from Berlin. I work for Casper Labs. I'm a researcher. I'm doing a lot of design on the economic side, like incentives, reward distribution, and also delegation. And we have been discussing a lot with Felix from Chorus One. So and he invited me. So I'm quite excited to listen to what everybody is going to say.
Okay, great. Thanks enough.
Cool.
Right, Brian.
Anyone else? Or
that should be at 25.
Okay.
I think we got you, everyone.
Okay, yeah, then I'll get started. Yeah, so I just wanted to give a bit of an introduction about some of the thinking behind this topic. Probably for many of you, it won't be too novel, but hopefully it will stir some good discussion that we can also take up afterwards. So yeah, I think some context, and I'm sure all of you will agree with me, is that really in the phase of a large transition from proof of work to proof of stake. And we've seen that with the launch of Tezos, with the launch of Cosmos, now with many Cosmos zones. If we look at new networks that are being created, probably something like 80 or 90% have some sort of proof of stake based system. There's a few exceptions, but they're really very few. We're seeing Ethereum working on a transition. So I think there's, no question, or it's a very high likelihood that the future is going to be based on proof of stake. And, in a few years, it will also in terms of market cap be much, much bigger than proof of work. And, despite DeFi having had, such a buzz and being so present in the mind share of the crypto space, I mean, if you actually look at the numbers, then, staking is much larger than DeFi. So I was checking on staking rewards before, and, the staking market cap is around 13 billion today, and around 8 billion is being staked. And that's around 10 times as much as that is locked in DeFi. So already proof of stake, even though we are, just at the beginning, and, even in this month, right, many of these new networks are only doing their test nets, incentivized test nets, or only about to launch, it's already achieved, a big scale. But one of the things that I find, sort of interesting to reflect on is what are the assumptions that were made when those protocols were designed. And a few years ago, I ordered this book called The Book of Satoshi. If some of you, I highly recommend checking it out. It's basically somebody went through all of Satoshi's old forum posts, and he kind of took out the most interesting ones and had basically sort of like compilation of Satoshi's writing. And it's very interesting to read what he was writing back then. And what struck me maybe the most is that Satoshi, even though he was like such a visionary person, and with an incredible foresight and incredibly brilliant, he didn't anticipate, as far as we know, that there would be mining pools and that there would be ASICs. So in a way, the way he expected that this proof of work and mining world would play out, it's just completely different. Literally has nothing in common with the way it was sort of outlined and expected in the beginning of Bitcoin and when it was designed, right? There was this idea of one CPU, one vote, and it's just totally different how it turned out. If you look at proof of stake, I think there's some similarities there. If you look at proof of stake, then for the most part, these proof of stake protocols have been designed with this idea in mind that people will have their staking assets. They will control it in their own wallets. They will sort of like watch the protocols, engage with the protocols, make these decisions. And that's how it would work. And then these protocols say, okay, like under these assumptions, we can tweak those variables, we can do those things, and we get a really decentralized network, or we get the right incentives and things like that. But I think we're already seeing that these assumptions are just wrong, and the consequences for proof of stake are going to be very significant and worth thinking about. And to give just just some examples of this, in Polkadot, I think there's the idea that if you want to vote in governance, if you sort of lock up your stake for a while, then you get more voting power, more governance power. So that makes sense, right? If I just have my own dots and I then have to give up liquidity, and it basically have to pay cost, I have to signal this long-term commitment to the network, and I get more say in the governance process. So then it makes sense. But of course, under other assumptions, it starts not making so much sense. And I think what we are seeing is those other things coming true. And in particular, two things. I mean, first of all, there's custodians entering staking. But I think the really significant one is exchanges entering staking. And exchanges entering staking means that they pool all the funds. And when they pool all the funds, they can do some interesting things, right? And one of the things they can do is they can give you liquidity, right? So now I can put my atoms, or I can put my Theses on Binance, and Binance can pay me an interest. So I'm earning all of the staking rewards, and at the same time I can still trade it. So that's of course a very big difference to when you're staking it. Let's say in the case of Cosmos, right, where you're staking and you have to wait 3 weeks, or in the case of Polkadot, I think they want to do 4 months. And if you think through this problem here, I mean, let's say you're a Polkadot investor, long-term believer in the network. But, if the price really goes through the moon, maybe you want to sell some, right? Would be reasonable. But if you're staking yourself, right, you have this challenge that at that moment, you're going to have you have to wait 4 months. Maybe the bubble's already over at that point. You don't earn rewards in those 4 months, and only then can you sell it. So there's a huge, huge cost that you're basically paying by staking yourself. And another factor is that we're already seeing a lot of kind of competition between validators for price, and that's totally understandable. That's how markets work. But a consequence has become that validation tends to be not very profitable, and there's a question of like, oh, maybe you need some adjacent business model to monetize validation. Well, of course, exchanges are in a very interesting position there, because an exchange can say, okay, if you just put all your coins on our exchange, we're going to stake it for you. We charge 0% commission, and just trade it on the platform, and they can make their money from trading fees. And if you kind of look at the math of this, you realize very quickly that the revenues exchanges can make from trading fees are so much larger than the revenues that you could make from commission on staking rewards, that this makes a lot of sense for exchanges to do. And I expect that they will mostly do that. We have with Binance the first ones who are doing that. Some of the other ones are doing some different things, but I would expect that other exchanges are going to be more in the Binance direction. And of course, the other thing is that you can do different things on an exchange. So in particular, you could use your staked tokens, your staked atoms, and maybe you can borrow some other token, right? You can borrow something, right? Basically use it as collateral, or maybe you can get leverage or margin. And there's basically more you can do than just stake. And so if you just look at what does it look like for me as a user, if I have to choose between, let's say, going with something like Binance versus staking directly, then I think the contrast is very stark, right? You can basically have a situation where you give up liquidity, you can't reuse your collateral, and you pay, you know, a substantial commission rate, you know, to pay for the validators. Or you can say, okay, I'm giving up my custody. I move my coins to the exchange, but I can trade them at any time. I can reuse the collateral in some ways. They charge me no fees, and also more convenient, better user experience in some ways. So that contrast is pretty stark. And my personal expectation would be that if things just sort of continue the way they are, we will end up in a world where most of staking assets are stored on exchanges. And of course, the thing is, they're not just going to be on some exchanges, but there are network effects there. The more staking, the more atoms are in Binance, right? The more liquid, you know, trading atoms is going to be there. The more attractive, the more they can offer other products around it. Network effects there. So I think it would be likely that we would end up with a majority of tokens concentrated on, you know, a few exchanges, 3-4 exchanges. And if we look at that outcome, what does that mean? It's a pretty scary outcome, right? Because in proof of stake, I mean, think of, let's say that happened with proof of work with Bitcoin. You had 3 or 4 exchanges controlling so many Bitcoins. I mean, it's still not good, and there would be concerns around it, but it's actually much, much worse in proof of stake, because in proof of stake, those exchanges then control the consensus. They could, you know, halt the network potentially. They can basically control governance completely. So you would end up with networks that might not be decentralized, that would not be very censorship resistant either. And it's very likely, I think, down the line, you know, if there was some sort of regulatory crackdown, or they say, okay, we need to now enforce those rules more strongly. Let's say if you talk about anti-money laundering rules, you know, they could go to those 3 or 4 exchanges that maybe control a majority, and they say, look, I mean, you guys have this control over the network. You are responsible now for making sure that on this chain, you know, no transaction takes place that doesn't go to an account that has been KYC'd, that has been verified. You know, we enforce sanctions on there, so people in Iran and other places like that can't use the blockchain anymore. So I think that's a very possible outcome that could sort of loom for proof of stake. And I would say that has informed for us, to a large extent, our thinking around, you know, around liquid staking. And if you look at this problem from a network perspective, let's say you look at it from the perspective of somebody designing a new proof of stake network, the problem is there's not very much you can do to prevent this outcome, because in the end, from a protocol perspective, the exchange, Binance, looks almost like any other user. It's just an address. It has, you know, atoms going in and atoms coming out. The only difference is going to be there's going to be maybe more transactions and bigger amounts, right? That's the difference. But otherwise, it just looks like any other address. So if you want to fix out, and all of those other things that they happen off chain. So you can't really, you know, change the protocol design to prevent this from happening. You can maybe make it slightly less attractive in some ways, but fundamentally, this is just inevitable. So the question is, what does that mean, you know, for proof of stake networks, and how should one deal with it? In our view, the best thing we can do is enable a lot of those things and those benefits, to providing those benefits to users in a decentralized way and without giving up custody. So this means that people should be able to trade their, you know, their staked assets, right? They should be able to sell them to somebody else whenever they want without having to go through an unbonding period. Now, an unbonding period may be necessary often from a network security perspective. So you may have the staked asset still being bonded, but some sort of claim that you can transfer that, right? So if you have that already, that removes at least one of those extreme drivers that will move people to a centralized exchange. So that's one thing. The other thing is, of course, this, reutilization of collateral. If you look at the exchange will be able to do leverage, will be able to margin calls and stuff like that, margin lending and stuff like that with your staked assets. But actually, if we sort of create liquidity, create tokenized versions of staked assets directly on chain, in a way, there's a possibility that this is going to be much better and much more powerful than what an exchange is, because it sort of unleashes this entire creativity and range of innovation that we see in decentralized finance, right? So you could potentially use, your staked assets for lots of different things. And, of course, the best known of this would be something like MakerDAO, right? Where you could go and you could put your staked atoms into something like Maker or, Kava, and you can get out the stablecoin, right? That's pretty cool. And you could do tons of stuff like that, right? If we have some sort of tokenized version of this. Yeah, of course, there's still going to be, the fees. But again, like, you can potentially just have more features that we can offer for these tokenized or liquid staking assets. So in our view, of course, in our view, it's very, very crucial for actually the long-term survival and sustainability and success of proof of stake, that this is sort of Pandora's box is opened. Now, the thing is that, when you start sort of unlocking all these possibilities, you also realize that, it's hard to predict what's going to happen, because there's so many different ways you could take it. We have, alone on this calls, right, various people who've worked on some kind of, protocols or some kind of approaches to creating liquidity around staked assets. And they're very different, right? So there's different approaches that you can take. We've at least seen sort of 6, 7 already, and, undoubtedly there's going to be more coming. So there are many different approaches that can be taken. The design space is very large. And so it's important to sort of take a step back, right? And think about, what do we want to accomplish? What are some of the criteria that one should use to evaluate different solutions? How do those different compare? What are some of the parameters or some of the things we're trying to optimize for? What are some of the risks? How should those be minimized? So I think there's lots and lots of open questions. And then that's sort of where this project comes in, right? We originally leaned more towards actually just building the delegation voucher solution. And then I think it was in conversation also with the ICF that they felt like, okay, actually, it's important to understand the risks here first, right? It's important to kind of think through, what does this mean for governance? What does this mean for network security? And change the topic a little, this project. And I think their points were absolutely justified to not just delegation vouchers, but look at all of these approaches and to look at them systematically and to try to understand how we should approach this topic for Cosmos, but also, for other networks. And I think we're seeing other proof of stake networks are, more or less aware of this issue, but it's also something that is not on their, it's not on the front of their radar. It's not a priority, right? They're trying to get their network live, and that's hard enough. And so to think through the sort of second order and longer term consequences of how are those economics going to play out, and what's going to happen when, for example, lots of staking assets kind of aggregate on exchanges, that's not something that, all of the proof of stake projects that we speak about really have the bandwidth to think about. So I think we have a chance here at Cosmos to be the first ones, and be sort of leading this wave. And I think many other proof of stake projects will end up being, informed and sort of taking on, hopefully, some of the ideas and maybe solutions that we come up with in this context. So let me see if there was anything else I wanted to touch on. Yeah, no, I think that's it. So from that perspective, super excited to work with you all. What we wanted to do for the rest of this is actually have sort of a first stab and a first attempt at thinking through what does a kind of a good solution, protocol, a good approach to liquid staking look like? What kind of characteristic does it have? So, at some point in the future, we want to do calls where, we have presentations from, all these different people, right? Where, like, let's say Sunny presents his approach, Stake Capital, Everett, etc., right? So that we can have presentations from all of these teams to kind of present, okay, this is how we want to do it. And I think that's important, very valuable. But what we wanted to start off with is actually have a more higher level discussion around what are the desirable characteristics and we actually look for when we look at these solutions. And I hope that will also help us to have a more, more rigorous and more systematic way of comparing all these different projects and approaches. So yeah, with that, I would say let's kind of go from my monologue and introduction to more of a discussion format. So maybe let me kick this off by asking the question: what do you guys think? What is the most important, characteristic that sort of a liquid staking solution, liquid staking protocol should fulfill? So yeah, Michael, you mentioned fungibility. Do you want to expand a little bit on this?
Yeah, so I think like because there are like 100 validators, 125 validators in Cosmos, for example. We don't want to have everyone building their own version of derivatives and end up, aggregating liquidity. Not disaggregating, intimidating liquidity across different kind of derivatives. You want it to be one single solution that's fungible across all validators, so that liquidity is there when eventually some kind of text comes out for us to trade it across validators. I think this is something that's very important because if you want to go up against centralized exchanges, we have to make sure that liquidity is abundant and not spread out across everyone. Yeah, I think that's my main point.
So when you say that, do you mean fungibility of design, like they all are using the same design, or do you want all derivatives from different validators to be fungible with each other? Like, is a chorus atom the same as a stake with us atom?
Yeah. So I think the ideal scenario is to make sure that every single validators, like bonded atoms, can be switched with each other, regardless of fees, regardless of whatever fees they set, regardless of the slashing rate. So I think this is the most ideal scenario.
In my design I was working on, so in which case every validator has their own ERC20 like validator share kind of contracts, so in order to restake or rebond with other validator, you can just swap two validators shares. So it can be like whatever the exchange rate for the validator V1 and V2 is. So basically, let's say V1 is earning more rewards than V2, then exchange rate for V1 would be higher. So depending on the the exchange rate, you can swap basically those two tokens, validator delegation vouchers, basically. So in that case, it kind of brings the fungibility between the validator shares.
So, I mean, I would say it's not really, I don't think that fungibility across shares of the same validator, of different validators, is a desirable property, because those validators actually do have different, you know, let's say one of them got like slashed and the other one didn't. You do want those shares to be worth very different amounts, right? And you want liquidity across like derivatives of different validators, and that, I think, having all validators use the same design, that helps probably make it easier to get liquidity across the different derivatives, but I don't think you want fungibility across of them.
Basically, I agree with what Sunny just said. What you're looking for is basically the ability to exchange these tokens. Otherwise, the tokens themselves are somehow worthless. So you need like really to create a system where you can exchange the tokens either between themselves or with the market. And on the other hand, the fact that the tokens are the same, it comes, for me, it's just like nice to have, but a nice to have that would need other things to be built in order to reach it. If you're able to give them liquidity through different liquidity pools or similar liquidity pools, it's already a good thing.
Yeah, I totally agree with that, which is why I say it's the ideal scenario. I think like, I agree with Sunny that different validators have different kind of level of risk, which means different validator tokens should be traded at different premium or discount to each other. But in the ideal scenario, like, to make it simple for delegators to use, I think it should be ideally, same pricing, same kind of tokens across everyone. Yeah, that was my point.
But I agree with you. I mean, this is one part of what we are working on, but for me, it's just like not part of the original design somehow, to put it this way. I mean, I don't see it as like the objective of staking derivatives, just to put it like this. If there is a design that allows to have that, it means that it goes beyond just having liquid tokens. It will go far beyond it, and it will be solving a lot of other problems at the same time, or trying to solve a lot of other problems. It won't be like a simple solution to implement and to use. So for me, it's different layers, to express it this way.
Yep, fair point.
Yeah, go ahead, Nicola.
Well, I come from maybe like it's not a different angle, but like what I would spend a little bit of time on is like, you might come up with a new design, a new feature, a new product, and let's say that an exchange comes up with something, right? And they have this bunch of tokens, they can create a new product. And we're like now here thinking about, oh, what's the implication for the security? What's the implication for centralization? And they might not care, right? Because in their business model, in their vision, these new products, this new feature that allows liquid staking, for them it works, but they might not care at all about the centralization, about the security that increases the decrease of the networks. So it's very important to know, like, who is the issuer, who is designing, and what do they want with this product? Like, what's the business model behind the product that they're designing? And if it comes from the foundation, if it comes from the protocol itself, if it comes from somebody external, if it comes from an exchange. So you have to see who wants to create the product and what's the business model behind it. And then what implication has on the networks, they might not care.
The good news is that they are not the ones participating in these kinds of discussions, and they don't have a lot of influence regarding the network. So what we have witnessed so far, and I hope it will stay like this, is that exchanges build products that are inside their exchange ecosystem, but they're not able to influence what happens on the network so far. The day they will be able to do this, it's going to probably become dangerous. Yeah, it might become dangerous for the whole networks that they will be able to deploy their own designs and their own products on.
Yeah. I mean, if you look at the case of EOS, then I think we already have a situation where the network is like controlled very much by exchanges, and they control block producer election and stuff. But I agree, and I mean, of course, Nicola, you're right. But like exchanges don't care. It's not in their business model. It's not in their interest. So I think it is about all of us, right, to create it in a way that is actually a positive for for those networks, and then positive but also competitive, right? It has to be a good product that people actually want to use, so a good approach. I don't know, maybe Hyung, I think that's low-level protocol acceptance. So basically a low-level protocol that kind of allows different designs on top. So I think that's a very something that we've also thought about, and I think it's probably a desirable characteristic. But do you want to expand on that point?
Yeah. So generally, I think stuck into specific design is risky, because we cannot predict future. So we don't know about problems or advantages. So I think as a protocol level, it would be better to build something like very permissionless and very acceptable protocol design. I think the best acceptable design as now is a interchain account, because it can put into different validators. It can be basically a chain who controls the account. Then in this chain, you can build any logic you can control in these assets in this account. So it's kind of same as a programmable staking also, but it needs VM language, which is not a general thing in proof of stake yet. So I think those kind of approach will allow more different kind of design to be built upon it.
So this is a different separate chain, right? So basically it's controlling stake of multiple proof of stake chains. Then like the problem is in this base chain itself, right? Because the security required for this chain is higher than all other chains combined. Sorry, did I?
This is one of the problems, yeah. This is one of the problems, but it depends on the hypothesis. Basically, if you have only one chain that is doing this chain will need to have a higher security level than the Cosmos hub. If it's multiple chains, I think we need to somehow model the security to be able to see what kind of behavior we'd see. But I think the approach of the interchain account is basically to allow multiple other blockchains to behave this way. So,
but then we are back to square one, right? Because we'll be facing the same issue on the chain with higher security and which is managing all the stake derivatives.
Depends how you model security. Depends how you model security. So basically, if you have one chain that can be attacked and that has a lower security level, I'm talking under your control, Ryan. By the way, but yeah, if you have a blockchain that has a lower security level than than Cosmos Hub, and this blockchain ends up controlling, I don't know, 80% of staked atoms or bonded atoms, you will end up with a very risky situation. Yeah, you'll end up with a very risky situation. If it's like 10 different blockchains and combined, you can say that these 10 different blockchains, they have a better security level than the Cosmos Hub. Then in this case, it makes sense. From my perspective, I mean, I digged a little bit, but this was one thing that Gauthier, that we discussed with Gauthier. We spent a lot of time discussing with Gauthier, and this is what we thought of.
So, in my opinion, basically, like every chain managing their own derivatives makes more sense, and then let's say probably this chain, which is basically handles the interoperability of all those stake derivatives, which is still more desirable than bringing the whole security to single chain and then managing that security of that network. If it makes sense.
Yeah, maybe one thing I could do briefly is I very much agree with the points, but so we wrote like up a bunch of kind of sort of rough criteria that we think are important, and maybe I can kind of go through them and then get your take on that. So yeah, fungibility, we kind of talked about. I think what exactly that means is a sort of open question, right? But there should be some sort of thing that results that also has like fungibility / liquidity. Maybe liquidity is the better word, right? But like in the end, you need to have something out of it that you can actually like trade. Otherwise, what's the point? And then I think just the question of decentralization is important, right? And decentralization, the solution shouldn't drive towards increasing the level of centralization, which could be that it really really rewards big validators, or in some other way it creates some sort of drive towards centralization. I think obviously it should be sort of friendly towards non-custodial holders, or designed with that in mind, and producing a good product for somebody who self custodies their assets. And then I think network security, right? We've talked a little bit about that, but it's an interesting question, right? Like what happens if now some asset that's sort of tied to a staking asset maybe moves to another chain, and then gets maybe there's one chain that a lot of those aggregate in, or there could be other questions around network security that are important to consider. But obviously we should have a design in the end, or designs would be good if they don't deteriorate the network security. And then I think Hyung's point, we also, agreed and had there, is this idea that there's some sort of modularity, some sort of flexibility that like, different people can like innovate on top of different ways. And then, there's the topic of governance too. So again, like almost all these proof of stake systems have some sort of governance, which is tied to the control of the private keys. So what happens when you create some sort of liquid staking object from that? I mean, and so somehow you want to retain, some functionality for, network governance. And I think that's also a very, very complex question. That's, going to be tricky to figure out, and probably varies a lot with different designs. Yeah.
In terms of interchain operabilities, like let's say if everyone is following same kind of structure or similar kind of higher level design, then also it makes more sense. Like they can innovate on like lower level, but then they can also trade or do all kind of things on the other. Let's call it derivative chains basically. So if they are following similar kind of structure, then they can do all kind of things on that chain, and still keeping the staking derivatives on the individually on their own chain.
Brian, I think we can add one more advantage we could offer, the system could offer to people that choose to use it, and that would be the delegator themselves can choose how their validator is going to vote. I think Coinbase has this, but most of the exchanges don't have it at this point. It's not something that can't be copied, and I understand most of the delegators really don't care how the vote goes. There'll be some apathy there, but giving them that choice, it would be an advantage over the current exchange staking structures.
Yeah. So that's totally agree. I mean, I think that's just a whole question of governance, right? And how is that handled in these liquid staking models, and how is it handled by centralized exchanges? I agree. I think centralized exchanges are not going to just users don't care enough about governance. Plus, it's actually complex. You know, if the ownership of, let's say, atoms constantly changes on Binance, and you know they take sort of daily snapshots and stuff, like who has the governance rights? It's easiest for them to just ignore it totally.
Yeah, it might not even be feasible for them to let their people, the token holders vote in their system because of that.
Yeah, I mean, I'm sure they could, right? But it would require like a lot of, you know, maybe effort and thinking and engineering, and for what, right? Like, I don't think it's sort of a competitive advantage for them. Of course, the flip side is that probably these liquid staking solutions are going to make it possible, or they might make it possible to do, you know, sort of vote buying quite easily. And you know that could be seen as a risk again, right? If so
yeah, that's definitely a risk. It would be well thought out.
Yeah.
If I can reiterate on a concept that it's about the blog post basically that I wrote. When we talk about a product and we issue a product, we call it derivatives because, you know, derives from something, and that's okay. But when we think about a product that is going to be traded, then we have a bunch of players that can come and see in this product a different use case that cannot care about anything about the network, but bring in trading features or edging or all different sort of stuff. So I completely agree with what's important and fungibility, decentralization, non-custodial, but this is the network perspective. But let's not forget that if you issue a product which is freely tradable, then there are a lot of players coming in that they have their word and that they have their impact on the same product. So you can design something, but the market players, you can decide what they're going to do with that. So that's also to keep in mind. You can design something with the network perspective, but also must keep in mind who is going to come and trade and provide liquidity and basically who's going to be on the other side of the trade. That's crucial when you issue a derivative.
Yeah, 100% agree. I mean, I think that's exactly sort of the thing that got us here, right? Is that in a way, people designing big networks sort of like didn't think that much through who's going to be on the other side and what is like an exchange going to do, right? And so, of course, that's totally right? Like, again, who's going to trade, how, why, what things they're going to build on top. Absolutely.
Okay. Well, basically, we have the liquidity, fungibility, decentralization. We have this list. How do you want to organize it? Do you want us to get deep into each subject, or do you want us to go through all of them quickly on this first call and then try to get deep into each one for the next calls? What is the plan?
Yeah, I think the plan is really to kind of discuss it today, you know, to try and get a plan, right? It's a community, so we want everyone to participate. I don't think we'll agree it today, but I think what we want to get together today is just a list of ideas, and then, you know, we can discuss it then. We'll probably take some stuff offline and just discuss what order is the best way to do it in. Certainly one of the ideas is to run through each of the proposals, like each of the, you know, Staffy, Everett, Unsplash, various DAO models, etc., and give everyone a chance to go through those. Whether we do them all on one call, probably not, but, you know, we might do 2 calls or 3 calls to give everyone a chance to kind of batch up the projects, let everybody talk about their own solution. I think in terms of what we're discussing today, I also think we kind of need to start thinking about writing up some of these things, like what do we mean by fungibility? Already I can sense that there's different, people are talking about different things when they talk about fungibility, and we're starting to mix fungibility and liquidity, which I think are separate. So I think we can probably look at maybe doing a call to break these down, but I would suggest what we would do each week, each fortnight is like write something up, circulate it, give everyone a chance to read it, and then get people on a call to discuss it. So one of the things might be to kind of look at this terminology of fungibility, decentralization, custodial, etc., and just start to write down what we think we mean by these things, and then maybe have a discussion to refine that. So I think it'll be a combination of have a call, get some ideas, then we'll go off, write stuff down. You know, we might do one-to-one calls with different people that have contributed, circulate it back to the community, and then jump back on a call and discuss. Does that make sense?
Definitely, yeah. That seems like a great plan.
Okay, Brian, anything to add to that?
Yeah, no, I think that's, I guess one thing that does come to my mind would be that, you know, maybe we could on our end sort of write up a kind of a rough draft of, you know, these deep explaining these points in a little bit more detail, but, you know, still short, like maybe 2 pages or something. And then circulate that. Maybe people can kind of add their own, you know, reflect on it, add their own thoughts on it, and maybe you could do another call next time, maybe kind of dive into these things in detail. And then maybe after that we could go into designs, you know, maybe start looking at how different people have different projects are approaching it.
Has anyone out there got other ideas of topics we should cover on future calls?
And yeah, Sonny, totally. Presentations on each design. Yeah, we do want to do that.
Yeah, I think that would be really useful.
Yeah. So yeah, I think our idea is probably to have like the next call again still on a high level, and then after that start going into having different people, you know, present, have an idea, you know, maybe we can have each time do 2 or 3 presentations, right? And have like, you know, 20-minute presentations and discussion and something like that.
Just one small thing I would like to add here, like as a small topic, is the ability to leverage on stakes and also in some designs, governance rights or rewards. And I think it's going to be quite interesting to discuss on those aspects and the potential consequences that it could cause to the entire ecosystem, whether it's going to be positive or negative. Yeah, I think that's one part that hasn't been covered yet.
Yeah, no, that's a great point. Sure, that definitely be interesting to talk about.
Can I add one more word to discuss in this topic? Because I think shared security is a very important keyword on this topic, because if everyone launched different chains, so every chain will be having less security to utilize, so nothing will be successful. So I think there should be some kind of big chain which is providing security for different applications. So that is possible via the shared security. So can we add those keyword in topic so we can discuss this in next call?
Yeah, I think that makes sense. I definitely, I think that already came up a little bit. It's a big topic. We don't want to get we don't want to get bogged down in shared security. It's a huge area by itself, but I think certainly we should look at some of these things in the context of what shared security implications there would be. Anybody got anyone else? Because I know we're coming close up to the end of the call here. I just want to wrap up in a couple of minutes. So anyone else? Good. We're good. Couple of minutes. If anyone has got anything else.
I think it's pretty much a good high level point of view, and we're covering most of the subjects. So yeah, it looks good, honestly.
Okay, cool. Yeah, so just let me wrap up then. Yeah, do check out the list that we have there. As I said, so we have this awesome liquid staking page. It's got links to everything we could find, blogs, videos, podcasts, like specs. So anything you can think of, research papers, whatever it is there, please send it on to us, stick it in the Telegram group or send us a pull request and we'll add that in. We want that to be the kind of place everybody goes to. I see suggestions in the chat here that we should write up a description of each protocol. Anyone who is working on like a protocol or a liquid staking product, please write it up, send us some links, and we'll put it in here. We can add it into the GitHub repo, but if you have it in a blog post or something else, that we can link to it here. We're also, I think, going to start writing up our own pieces for this because it will go into the final report. So I'm already working on a description of Staffy protocol. So Liam, I'll be in touch with you to talk through that. I think we've nearly finished the description of that. So I think we'll get it approved by Liam and make sure that we have all the details right, and then we'll circulate that for review. So we would like to do that with other projects, like to help kind of write up a brief description. So as before we get into the deep dive on these, people can have some materials to read. And the idea would be to kind of, I think what I'm trying to do is make sure we align on the terminology and the criteria for how we evaluate these. So, rather than having, 10 different white papers that use different language and different terminology, try to distill these in a way that it's easy to compare them with each other, because I think that's going to be important as the weeks go by. Let me just check here, final things. So yeah, jump into Telegram anytime, just or create an issue on GitHub. If there's anything in particular you want to discuss, feel free to create an issue and start a conversation on GitHub. The video for this will be on YouTube, so we'll hopefully upload it later today or tomorrow. So we'll circulate the link there so we can share it around. And if you can retweet stuff on social media as well, just so that we can get it out there. The next call is in 2 weeks, so January 30th. I think we'd like to do it a bit earlier because I know like we have people in Singapore, China, Korea who are at great inconvenience for sitting there at like 2 o'clock in the morning. So I think we'll try and shift it a bit earlier if we can next week. It means, I guess, people in San Fran might have to get up a little bit earlier to be on the call. But I think it's only fair that we shift it around so so that people in Asia are not on midnight calls all the time. So I think that's it, Brian. Anything from you?
No, that sounds great.
Okay. Well, look, really appreciate it. We're delighted so many of you turned up today. Great start, great discussion so far. And we really look forward to to having really interesting discussions over the next 4 months. So thanks a million, guys. Cheers.
Thanks so much. See you.
Thanks.
All right.